to the Inspire Wealth podcast with Prof, where we dive into the world of real estate investing and wealth building strategies. I'm your host, Mallory Meehan. I'm a real estate professor, attorney, and seasoned investor here to guide you through the ins and outs of creating wealth through real estate. If you're looking to take your real estate knowledge to the next level, don't forget to subscribe to stay up to date with our latest episodes and offerings. Welcome back to another episode of Inspire Wealth. I am your host, Prof M, aka Mallory Meehan, and today I'm joined by Michael Albaum. Michael, welcome to the show.
Thanks so much, Mallory. Super excited to be here and chat with you.
I'm really excited too. I know we were chatting a little bit offline, but Michael, why don't you give our audience a background on who you are and kind of how you got your way into real estate?
Totally. So I did the thing that probably so many of your audience and students did. I went to school, got good grades, I went and got a good job, and immediately realized I wasn't going to get to go where I wanted fast enough financially when I got that first paycheck. I'm a California native, so I have the blessing of having those California sunshine taxes hit my paycheck every 2 weeks. So I was like, this isn't going to work. There's got to be another way, something else I could do. So I got that purple book that I'm sure, again, so many of your audience members have seen and read, Rich Dad Poor Dad. And it just something clicked for me because I'm an engineer. And so I speak in math and numbers and equations. And so the whole mathematical side, to buy something, charge for it, and assuming your expenses are less than what you're bringing in, you're going to have money at the end of the day. That just made total sense to me. So I started investing in Southern California in a market that I kind of knew, got way over my head pretty quickly in terms of the purchase price, but I was like, I'm not going to let that stop me. And then what I did was I was traveling for work all over the Western US. And what I realized pretty quickly is that as soon as I left the state, I could buy things. I could buy a 3-unit for the same cost as what I bought a single family for in California. And then I went further into the Midwest and I could buy an 8-unit for the same thing that my first single family cost. So I just realized that if I can go remote, if geography is not a restriction for me, the US is my potential oyster, and I could do so much more. So I really grew quite quickly and was doing some commercial multifamily, some value add stuff. I built a course for a tech company here in the Bay Area. I've since started a prop tech company helping investors invest throughout the country. I lived in a van for a while. I traveled around the country and was investing, traveled internationally, was investing here in the States. So done a lot, just enough to be dangerous, and have made all of the mistakes possible. So hoping we can share some of those with your listeners to help them avoid.
Absolutely. I mean, I am in the same boat with you. I mean, I think people expect that if you've like researched it enough and educated yourself enough that nothing will go wrong. And it couldn't be further from the truth. You just have to prepare for it and understand how to move forward from it. And I think, and this is a little bit off topic, but I think it's important to note that even when things do go wrong, it's important not to jump ship. And
100%.
I think that a lot of people get really nervous and really panicked. And, we see that with the stock market going down and people are panicked thinking, I don't want my losses to be any more. So I'm just going to sell at the loss now versus riding it out, getting past the storm because calm seas are on the horizon if you can withstand the storm.
Yes. And actually, to that point, Mallory, I'm so glad you brought that up. One of the reasons that I love real estate investing is that it is this semi-illiquid asset in that when things do get tough, and I say when, not if, because they will, when things get tough, it's not like you can push a button and go sell the thing. There are things that have to happen in order for you to be able to sell this property, which is going to take time. And that time gives you a little bit of breathing room to say, okay, let me take a step back. Let me reevaluate, determine if I really want to do this. Because fastest probably you're going to be able to sell a property is 30 days if you're ready to go. And so you've got time. So I love the fact that it's this semi-illiquid asset, but still something that everybody needs and most people are looking for.
Right. Absolutely. Okay. So Michael, the first property, I really want to dive into the first property that you bought. So tell me what your strategy was with that first property. Tell us how much it was. What did you do with it? Give us a little bit of detail on that first property you got in the Southern Bay, California area.
Yeah, totally. So I actually, in one of my engineering classes in college, built a financial calculator. That was like the assignment, was to build this thing, build an amortization table and schedule. And so it's super basic. So I started evaluating deals as soon as I came out of college. Because I got that job, then I read that book. And so I figured out that if I could buy a house for about 200 grand that rented for about $2,000, I kind of came into the 1% rule because I didn't
Yeah.
know that that was a thing. I
Yeah.
backed into it, which is funny because it works, right? So there's
Yeah.
a
It
reason
works.
behind it. The math supports it.
Hmm.
So that was my budget based on the amount of money I had saved and where I was comfortable paying. I said, okay, this is where I want to be. I used an agent in a market that I grew up going to kind of on vacation in Southern California. And so she was a family friend, and every house she showed me was minimum 300,000. And I was like, crap, this is not going to work. I was like, well, I guess I'm not going to invest then because it's way outside my budget. And what my dad helped me realize is he sat me down. He says, look, you need to understand what is your monthly actual expense load look like? Because yes, $100,000 over your budget sounds like a lot of money, and it feels like a lot of money, and it is a lot of money. But because of the way loans work and amortization works, when you spread that out, your actual delta in payment is a couple $100 a month. This
Hmm.
was back in the day when interest rates were like in the fours, low fives.
Yeah.
And so I was
Yeah.
like, well, wait a minute, that I can stomach. I make a great salary at work. I have very low expenses because I'm traveling all the time. I live with roommates. I'm living well below my means. I just kind of continued that college lifestyle in terms of
Yeah.
expenses, but was earning a full time salary. And I was like, okay, well, that I could do. And so it just kind of got me over the hump. So I bought this first property for 295,000, turnkey single family home. It was actually a bank owned foreclosure. And I just wanted to get a tenant in place as soon as possible. My property manager was also my agent. She said, yeah, this will probably rent for about 2,000, 2,100. I said, great. Not quite the math that I was hoping for.
Hmm.
But again, what my dad showed me is he goes, look, buy this on an interest only loan. That way you're going to minimize your monthly payment. You're not going to eat away at the principal balance, but you'll at least hopefully by the time the IO or the interest only period ends, which was 5 years down the road, the rents will have caught up to a point where it would now support a full principal and interest payment. And again, I was like having my mind blown. I didn't know this was a thing. So that's what
I
I
really
did.
like your dad. I mean, I think maybe we should like, collaborate here.
Totally. He was a incredibly intelligent person, very savvy business acumen. Did a little bit with real estate, not a whole lot, and so we were kind of learning it together. But he understood some financials. Like yourself, he had an MBA, so just really a bright guy, someone I looked up to very much. So he showed me how to structure this deal to make it work. And so fast forward a couple of months, I didn't get a tenant, and I was freaking out. And so my property manager found someone, but at 1810. Like I remember the numbers like it was yesterday. It's been more than a decade. 1810. I was like, oh my God. The math just worked. The math just worked. And so I was like, put him in there. And she
Hmm.
goes, it's against my better judgment. I'm not crazy about their score, kind of their tenant rating score. And I said, I don't care. Put him in there. I need money now. It ended up being one of the worst decisions I've ever made when it came to investing because they were the tenants from hell. We could get into that if you want to. I could share some horror stories with you, but it just ended up being really awful. And so, kind of to your further point of not jumping ship when things get hard, it was super hard. Like it was super super hard. All of the things you heard about happened.
Hmm.
But I didn't give up. I was too naive to know that this wasn't the norm. I just thought, okay, well, this is real estate investing. I hope the next one is better, and so kind
Hmm.
of fell forward and just progressed through my investing that way.
Yeah, I mean, I think that you share an experience that a lot of people share, and something that I have also experienced. Problem tenants are some of the hardest things to overcome, and I think that a lot of new investors just really need to understand the vetting process, and it
Yes.
is worth waiting for the right tenant, and following sign kind of straight line. Here's exactly the things that you're looking for in a tenant. Credit score is going to be a key indicator on if they're going to pay their rent. Are they going to pay their rent on time? Past rental performance and following up with references. I mean, it's kind of the same thing if you're hiring somebody. It's like, would you want this person working for you? It's the same thing. Would you want this person living in your property?
Yes.
And it's great to have somebody bringing a check, but at the end of the day, you want to make sure that person who's bringing the check is also taking care of it is your business, right? Your
Yes.
properties are your business. So
Very much so.
yeah, it's like hiring an employee.
Yes. And there's a reason why like every property manager throughout the country uses the same scoring metric of just those things you mentioned. And
Mhm.
here I was being a brand new investor. I'm like, no, 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 it's fine. It's fine. Just put them in the property. And
Yeah.
so, it bit me in the butt, but it's not a mistake I'll be making again. which
Yes.
is kind of the beauty of real estate investing. I think that when you make mistakes, most of them are going to be recoverable. And then you have that in your back pocket. You have that life experience for every other deal you go on to do in your entire life. So use it as a stepping stone. Don't think of it as a step backward.
No, absolutely. And I couldn't have said it better. I think it's a great learning opportunity. Sometimes, we pay for our education, we pay for college, we pay for things. You're going to pay for your real world education too. And that sometimes comes in the form of hard lessons learned.
Yes, there's an expression that I've heard. It's not mine, but it's I never trust anybody without a limp, and it's basically saying like if you've only had good things happen to you in life and business, like you're not resilient. You don't
Yeah.
know how you're going to perform when things get tough, and in this business, things will get tough. So
Right.
just know that they're coming, and it becomes easier to deal with if you're caught off guard thinking it's rosebuds and fairy tales. And when the hard stuff shows up, you're like, "Oh, this wasn't part of the deal." Like, no, it's always been part of the deal. You just didn't have your eyes open.
Yeah, absolutely. Okay. So you bought this single family home. Did you hold on to it after those tenants or did you end up selling?
No, I held on to it again because I was too naive and too green to know that there was another option. And so I held on to it for, I think, 7 years, 8 years, something like that.
Okay.
And
So
then,
you had an interest only for 5 years.
mm-hmm.
Okay. And then what did you end up doing after the interest only period ended?
So it was funny. My mama was always joking, like, "Oh, my dad's always right about stuff." Well, he was right about this thing again too, and that the rent caught up over that 5 year period to now support a full principal and interest payment. So my cash flow decreased because now I had a much larger payment.
Mhm.
But I was making killer cash flow along that whole time, especially as the rent was increasing and my expenses were not significantly increasing. This was at a time when insurance was not skyrocketing. Property taxes in California are set based on the purchase price. So those were locked in, plus an inflation factor or inflation adjustment.
Yeah.
So my expenses were staying relatively flat, and the rent was vastly outpacing the rent growth rather was vastly outpacing the increase in expense costs. So it was awesome. Like it was just a killer property. The first tenant sucked. That experience sucked, but overall, trajectory wise, it was an amazing deal.
That's awesome. So when you ended up refinancing into a traditional mortgage, how much had your property appreciated in those 5 years? Do you remember?
Probably like 150 grand, 200 grand, something like that.
Nice.
Yeah, I ended up selling it like 7 or 8 years later for 615 and bought it for 295. So it doubled, more than doubled in that 7 8 year hold period. So that
That's a
five
great
year,
investment.
yeah, like it was amazing. It was
Yeah.
totally amazing. And so all that stuff, all that crud at the beginning, while yes, it was hard, and yes, it was unfortunate, it was all worth it. I would do it 10 days out of 10 over again. So I think
Yeah.
that's the other thing people have to remember is like short-term pain, long-term gain, like
Hmm.
to not be too cheesy about it, you
Yeah.
know?
No, and I think that's so valid, especially when you're looking, even if your cash flows hadn't been as great, California historically had really high appreciation rates. And so while you may not have been getting as much in cash flow if you would have gone a traditional non-interest only route, the goal would be I'm holding this property because I know it's going to double or almost triple value within a short 7 years. Like that's in the grand scheme of thing, that's not that long for something
Right.
to, you know, put a value of 600 and how much? 615,000.
Yeah.
Crazy. Okay.
Nuts. Totally nuts.
And that's why I love real estate. I love real estate because you're not going to find other assets that do this for you.
No, no. And I was getting tax benefits the whole time and a little bit of cash flow. And I think the best part about that deal, Mallory, was like I didn't do anything to the property. All I did was own it. I owned
Yeah.
it and operated it and paid my property manager and paid my bills on time and like the end. It wasn't sexy. It wasn't special. I didn't do anything amazing other than happen to be in the right place at the right time and take a leap of faith and buy the thing.
Yeah. No, that's awesome. Okay. So you had that property. Now, how long until you got into your next property?
A year. I
Okay.
told myself I'm going to do this once a year for 10 years. And in 10 years, I'll have 10 properties and that'll be good. That was the extent of my thinking at the time. I was like, 10 equals good.
That's the silver lining. If I
That's
get
the
to
silver.
10,
Yeah,
I'll be set.
that's right. That's right. And so, because it was making a couple $100 a month, and I was making a little bit more than that in my job, excuse me, 10 properties collectively at a couple $100 a month
Yeah.
would have been just shy of what I was making at my job. And I realized the tax benefits and yada, yada, yada. So I was like, okay, that'll work. That should be
I
great.
could I could quit my job and just live off of the cash flows and
Exactly.
yeah.
Exactly. And
Okay. So the second property, what was your strategy with that one?
literally same rinse and repeat. So
Rinse
I
and
ended up
repeat.
buying a brand new construction. This was a condo this time. Brand new development. I bought it from the builder because they were having insane sell-off specials because they had to get these properties off their books, which is like one of the best kept secrets is the wrong term, but like strategies, I think
Oh
for
yeah.
especially newer investors, they
Hmm.
financed the deal. They gave me a killer rate and they discounted it massively because they wanted to get it gone. So they were able to kind of double end the deal is the wrong term because they sold the property, but they also got the financing piece revenue from me. And so it was an amazing deal for them. I got this killer deal. And it was just a brand new turnkey rental that the same property manager managed and put a tenant. That one was a lot smoother for sure.
Yeah. No, that makes total sense. Now, I'm curious as your down payment strategy. Was it just a matter of you saved up and then you plugged it in? Did you put 10% down? Did you put 20% down? What was your thought process behind these new investments?
Yeah, so it was a mix of a bunch of different things. So the first one was just traditional down payment. I had saved up a bunch of money. Since I was 16, I'd always worked at least two, if not three jobs. So I was always hustling, always had side hustles. So I had a significant amount of savings by the time I came out of college. Second one, my grandfather passed away, and there was some inheritance there, so was able to use that part of that as a down payment. But then I also used a 401k loan to get into
Mm,
that deal. And so that was this other amazing pool of money that I didn't even realize I had access to. And so at the time, I was able to take out up to 50% of my portfolio value, up to 50K. There's like, this was through Fidelity. And so that was the term at that point. And I paid interest on the loan, and I could choose the term in which to pay back the loan. And I think it was like 5 years was the max. So I'm paying interest, but it goes to myself. It goes
mhm.
right back into my account, and it just gets deducted automatically out of my paycheck. And so I was like, okay, this is the best thing since sliced bread. So leverage kind of those three things: savings, this little inheritance I got, plus the 401k loan to get into that second property, and it was 20%
Yeah.
down.
Okay, that's awesome. And I think I've also done the same thing with my 401k. And so I think it's a powerful tool that a lot of people don't realize that if they do have a 401k, they can use it as a savings vehicle.
Yes,
And, basically it's like a checking account where, you take out the money, you put it into something else, but then you got to pay yourself back and you're going to pay yourself back some interest too.
yes. And so I think the important thing that people understand with that is like there's this opportunity cost of not having the money in the stock market. Well, we're
Hmm.
recording this in kind of crazy times in 2025 when the stock market is in a bit of a tailspin. So if you
Hmm.
took your money out of the stock market and put it into real estate via this 401k loan, you look like an absolute genius right now.
Hmm.
So there's
Yeah.
the potential growth that you're missing out on, but you're also hedging you're hedging your risk against the downside. So I love it. I think it's a phenomenal tool to have in the tool belt.
Yeah. And I think since a lot of people are only using 401ks as part of their retirement vehicle, like this is the best way for them to even get into real estate. If they don't have the savings, they don't have the means for the down payment. Well, let's borrow against what you already have. And that way you can take it out. There's no tax penalty to taking it out as long as you're paying it back with the interest. And then see, can you put that money into something else that's making you more money than what you were getting in your 401k?
Yes,
Not to
yes.
mention the tax benefits now.
Right. And the best part about this, in case any of your listeners are maybe unfamiliar, is there's kind of two ways to invest in real estate via a retirement account. One is the retirement account could own the thing if you're using a self-directed IRA. That's not what we're talking about, where all the cash flow goes back into the IRA. We're talking
Right.
about using 401k for the down payment. All of the cash flows, all of the tax benefits, all of the appreciation benefits goes to you individually, not to your 401k. So it's like just this amazing, amazing thing to be able to tap into.
Yeah, absolutely. Okay, so second property was a condo, and how close was it to the first property?
5 minutes, same
Okay,
market, super close.
same market. So, what was your strategy moving forward for your next couple of investments?
So I went out of state because I was traveling for work, happened to be in these locations, and I was like, I'm a real estate investor now. So I'll go look on Zillow at what things are renting for and what things are selling for. And at the
Yeah.
time, you could do both the purple and the red tab or filter, which for anyone who's maybe not familiar, that's the for sale and the for rent listings. I could turn them both on at the same time. I'm like, let's just see what things are renting for. And I was like, holy crap, things are selling for the same price, around 300,000, but they're renting for like 1.8 times the rent. I was like, oh my God. And because I was a math guy, because I was an engineer guy, I'm like, this makes total sense. I'm like, all the rest of the numbers don't even really matter at this point. This thing is for sure going to cash flow. And so that was in Missouri, in a little town in Missouri where I happened to be for work. And so again, bought property there. And I was like, this is amazing. And then I happened to be in Alaska for work. And I'm like, I'm a genius. I'm so well diversified. If anything happens in market A, I'm in B through E. And what really ended up happening was I was herding cats trying to chase down 6 different property managers, trying to get updates on 6 different properties. And I
Hmm.
was like, this is not what it's about. Like, this was supposed to be not, this is supposed to replace my job from an income perspective, not from a time perspective. And so
Right.
I got some advice from a good friend who was way further along in his real estate journey than me. He says, Michael, he's like, dude, no, you're doing it all wrong. He says, what you've done, great. Don't do that anymore. Go focus on like one, maybe two markets, hammer them as hard as you possibly can. Watch what happens. It'll blow your mind. And I was like, okay, I mean, that's kind of counterintuitive to everything I thought I knew about investing and diversification. But again, kind of like Rich Dad Poor Dad talks about, it's like, no, go be the person to do the thing that you're trying to do. And so that's what I did. I found one market, and technically it's two, but it's like across a river and across state lines, but people live in both and work in both. So I
Hmm.
call it one, and hammered it as hard as I could. And the results blew my mind. I was astounded at how much easier it was from an operational and growth perspective to make one phone call to one agent to find out about all the deals in that market, and make one phone call to one property manager to get updates about the 5 properties that I happen to own there. And it was just so much easier. I didn't have to go relearn every market. Oh, I
Hmm.
guess you have to go relearn every market. You want to go become a market expert to a degree
Yeah.
if you're going to go invest somewhere. I was
Hmm.
doing that every new market I found and thinking, huh, I am so smart. Yeah. And so it just, again, operationally became so much easier. And I was able to really focus and be a better investor because of it, because I was able to so much more um, intimately learn a market because I was just operating there more regularly.
Yeah. No, that makes total sense. Now, what market are you hammering in right now?
Asking for the secret sauce, huh? I see what's going
I'm,
on.
I'm asking for all the secrets. Where are you at? What are
All
you
the
doing?
cards all the cards are on the table. So this is in Cincinnati, Ohio,
Okay.
and Covington, Kentucky.
Okay.
And so I landed Covington, Kentucky on, again, on the Zillow map. Nothing special, nothing unique, nothing tricky or fancy about this. Red tab, purple tab, Zillow. Where were things selling for about 100 grand and renting for about a grand? That was my criteria. And and okay, thirdly, where were there a bunch of those bubbles? Because I didn't want to do this just once. I wanted this process to be repeatable because I got that advice. So I said,
Yeah.
okay, I want to find a market that supports my investment thesis from a financial perspective. Where can I go do this not once, but twice, 3, 4, 5 times over? And Covington, Kentucky fit that bill. And then then it turns out Cincinnati, Ohio is across the river. So I was learning more about that market, ended up investing there as well. And again, it's just been such a benefit to streamlining things. And you develop a reputation too. That's the other thing that I didn't realize was going to happen. For better or for worse, people start learning and hearing about the people that are doing deals in a particular
Yep.
market. And so
Right.
be good to the people that you work with, treat them well, take care of the folks on your team because they talk, and you want to be known as the investor that's doing deals the right way,
Yeah.
and that operates the right way. And so I had somebody call me up and was like, hey, Michael, I heard you just bought this building. I'm about to list the one next door. Would you be interested? Before it even hit the market. I'm like, holy crap, this stuff happens? Like, I'm just a guy. Like, this is the kind of stuff that shouldn't happen to me. So it was really amazing to have my eyes open to kind of this whole new world, whole new
Yeah.
way of investing, of what was possible.
No, that's awesome. And I'm really glad that you got out of the California market. Obviously, no offense to all the Californians out there, but I think you made a really smart choice in moving into the Midwest because, that area is definitely more conducive for investing and support stronger cash flows, we'll just say.
Yes, absolutely. But I will tell you, Mallory, actually, I think the best performing property I have from a cash flow and cash on cash perspective is in California.
But
But
if you were to repeat that now, would it still be the same case?
no,
That's it. That's the
I
that's the
know.
real thing.
Right.
Like your rinse and repeat method. You bought at the right time because
Yes.
when you said 300,000 for a place in California, I was like, I have no idea where you're at. Like I don't
Right.
know.
Yeah. It
I don't
was a
know where
double
this
double
is.
wide. Yeah. Yeah.
Right.
Yeah.
Yeah, like a shack on the side of the road in some random city like
Yes.
you know
No.
so I think to your point it's understanding what's going to make sense now but also allowing you room to grow and expand within that market and I think also maybe focusing on a market that's not necessarily appreciating at a hugely accelerated rate because that shows you that your entry to get into new properties is still going to be pretty manageable.
Yes, exactly. Yeah, I think you said that beautifully. Like thinking about step 2, 3, 4, and 5, not just 0 to 1, which is where I was for so much of my investing career.
Yeah. So when you got into this Kentucky, Ohio market, your strategy changed because you're obviously in a different market and your investing type changed. So now you're trying to move into more multifamily. And so tell me about how getting into multifamily versus single family kind of changed, some lessons learned, and some things that you would suggest for others to maybe look at.
That's such a good question. So, again, I was the numbers. Numbers were driving pretty much every decision I was making. I was like, oh my God, I could buy an 8 unit. The rents, I think, in place were $500 to $600 more or less. So, and the sale price on this was 305 for an 8 unit. So, yeah, it's just
Crazy.
like insane. So you're making what is that, 3,200. So like you're north of the 1% roll on the purchase.
Mhm.
And rents were way under market, which I didn't really understand how at the time that was a good thing. I was like, wait a minute, that's bad. Why don't they just get the rents up to market and then sell the property? But
Yeah.
that's a conversation for another time. So
Yeah.
what I realized is that when you're making change on any property, the impact is going to be felt based on the number of units, likely. And so if I got a $15 a month rent increase on my single family, I'm making an extra $15 to my bottom line. Now it's going to flow through property management expenses, yada yada. Let's just forget that for a minute. So $15 on my bottom line. If I do that on an 8 unit property, that's what, $120 a month to my bottom line. And
Mhm.
so what I realized and started doing more research on is like cap rates and how cap rates work. And a cap rate is simply a mathematical equation and determines the value of a multifamily property or of a commercial property. And it's a function of the net operating income. And so, for anyone unfamiliar, net operating income is simply all of the income, the gross income, minus all of your operating expenses before your mortgage, does not account for the mortgage, divided by the purchase price or divided by the value of the property equals the cap rate. So, it's a 3 equation formula. And if you know two, you can solve for the third. And so, I was like learning about this, like, holy crap, this is insane. So, if we just take this example, $15 a month. Well, I'm going to do some quick math here, if that's okay.
Yeah,
If we take
absolutely.
$15 a month by 8 units, that was 120. And on an annual basis, that's $1,400, $1,440 a year in additional revenue that this property is making because of this, whatever change we did. Maybe it's we put a utility back on the tenant, maybe we just increased rent. At a 7% cap rate, that adds an additional $20,000 in value to the property. And so I just realized, like, holy crap, I knew about leverage, but this is next level. And so it's applying the concept of leverage to a property performance. And I just like clicked for me that I could financially engineer properties. And I didn't know that was a thing. And so I started looking about, okay, how can I be super opportunistic around changing what the NOI of a property is? Because again, at the single family world, there's only so much you can do. The rent is the rent is the rent. Versus in the multifamily space, yeah, the rent is the rent is the rent. A market will only bear what the market's going to bear. But there are little things that you can do. You can add amenities. You can make the property nicer. You can again, there are just so many levers to pull that
Mm-hmm.
are able to impact the financial outcome in such a big way that I'm like, forget single family. This is like child's play. This is where I want to be. So
Mm-hmm.
that's what I spent the next several years doing, cutting my teeth and getting my butt kicked all over this place because I had no idea what I was doing, but I figured it out.
Yeah. No, that's awesome. And yes, like you said, cap rates are a great way to kind of compare commercial properties on a yield basis. I generally say that a cap rate is similar to a yield on a stock or on a bond. What you can expect is kind of your return, but with that return, sometimes also indicates that there may be some risk tied to the property as well, whether that be the fact that you could have a high return, but you're going to need to put in some capital and make some renovations.
Right.
They could be under rent, under market. So just like you said, now, you got to wait until those leases end before you can then increase the rents. And so depending on when that period of time is, you're still going to kind of be under market. But excellent evaluation, and obviously from the engineering different formulas and different ways to look at things. So how many single family do you have currently, and how many multifamily do you have?
So today, I think it's like three or five single family, something like that. And then the rest is multifamily, and the total is like 68 units, I think.
Nice. And that those happened over how long of a span of time?
12, 13 years, something
And
like
do
that.
you own them all as an individual, or do you have business partners with you?
I have one business partner on one of the properties.
Wow, that's incredible. I give you mad props for that.
Thank you.
Um, that's really cool. So, when you're looking at buying new properties, tell me a little bit about, because I know we mentioned you did the traditional kind of mortgage. Are you doing any other like cool creative things with some of your properties to maybe take out equity and then buy new properties, or what are you kind of working on now?
Yeah. So right now, I'm looking, I love the midterm and short term rental space. And I think I'm actually taking this course right now on short term rental management remote because it's something that I've never been good at. I was never comfortable with. But I had this kind of aha moment from chatting with the guy. His name's Kirby Atwell. He's got an awesome course, awesome podcast. And he was like, look, people think about short term rentals only as this vacation, luxury, glamour, and that's just not the case. Like there are vacation rentals or short term rentals all over the country that are not that whatsoever that make incredible cash flow. So why are you competing with the giant behemoths of the world that have unlimited capital that are buying these mansions? And it's this never ending amenities arms race. Like forget that. Go do the not sexy thing. Go do the boring thing and buy one of these rentals and make it into a short-term rental and cater to the traveling professional that is there for a week for a work assignment or there for a weekend getaway with the friends. Like there's so many different ways to think about this. And so I had this light bulb moment. I'm like, oh, that's awesome because everyone's talking about, oh, cash flow is so hard to find these days. Yes, it is harder, but it's not necessarily hard. And so I'm just refining the strategies that I've been using because most of what I've done is long-term rental in the past. I've done some short-term rental, had it professionally managed. I've personally managed short-term rental locally. I've managed midterm rental from afar. So I'm just missing this short-term remote management piece. So
Yeah.
that's what I'm really focusing on right now. And I don't even think that was your question, was it?
No, but that's okay. I love it. Uh,
I've
Well,
got new
I asked
data.
if you're doing anything creative, so that is creative. You're
Yes.
learning a new skill. I asked if you're, using any of the equity from some of your properties and deploying it in different ways.
Yes.
But I love the fact that I have short-term rentals right now. I'm actually converting them to long-term, so I'm a little bit opposite of you,
Oh,
just because
interesting.
of regulations and different things that have taken effect. It doesn't make sense to keep them as short-term rentals. But I'm interested, to hear about your experience with managing them afar. I manage them here locally.
Okay. Okay. Yeah, we could totally get into that. So,
Yeah.
to the crux of your question, full
Yes.
disclosure, I've got new dad brain. So I've got a 3 month old
That's
at home.
okay.
So I'm like, my brain is not
I
functioning.
understand. I have a 4.5-year-old and I still have the same brain.
Okay. 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 So it gets better. Perfect. I'm so glad to hear.
Yeah.
So, creative strategy. Yes, 100%. I think in this day and age, you probably have to be to make things work. So one thing I've done, I'm not touching any of the equity in the properties in terms of cash out refi, because I was listening to the Fed when they were telling us they were going to raise interest rates. So I spent the 8 months prior insulating myself from that, getting as long-term fixed debt as I could. And I'm super, super thankful that I spent the time, energy, and effort to do that. It's paid off in such a big way. We just finished a remodel on our home. The scope started like this, teeny tiny for those of you not watching on video, and grew into an entire house remodel like it so often does. And so I was like, wait a minute, we were planning on refinancing when it was all done, hoping that rates would have come down by now. They haven't. I was like, well, let's just go get a HELOC. So we went
Mhm.
and just got a HELOC on the property. Granted, it's at 8%, but it's interest only. And so I'm like, oh, we can just take this money, go buy properties cash, turn around, refinance 80% of or probably 75 realistically, 75% of our dollars out, have a 30% loan at 8% interest only, and then 70% financed at whatever the rate's going to be. And so that's a strategy that I've used in the past that has worked really well. You get the benefit of buying something all cash, which usually gets you a better purchase price, and then at the end of the day, it's financed, and so six of one, half a dozen of the other from an ownership perspective. And if you do some value add in the meantime before you go and refinance your capital out, this is often referred to as like a BRRRR method, or a BRR, buy, renovate, refinance, rent, repeat. And I said that in the wrong order, but basically adding value to the property such so that you can refinance out all of your money. And so we, in an ideal world, have no HELOC money left in the deal, and it's not, so essentially no money in the deal. And then any return, any cash flow we're able to generate from a cash on cash return perspective, the answer to that equation becomes infinity. And
Yeah.
so that's a super exciting opportunity. So again, kind of leveraging the HELOC, leveraging some cash that we've saved, and with the short-term and midterm rental strategy, blending those things in a smoothie, and hopefully it tastes pretty good.
I love that. No, that's great. Now, your short-term strategy, are you using those on your multifamily or just on your single family?
So to date, they have just been on the single families. I just made a phone call this morning, so it's so timely that we're recording this, to the city in which I'm planning on doing short term on the multifamily. And turns out I am eligible based on my location. They have some really significant rental restrictions based on hosted versus non-hosted, and city blocks, how many rentals they'll allow, short-term rentals allow in a city block. I
Mhm.
qualify based on where my property is. So I'm like, let's go test this thing out on a 4 unit. Let's convert one or
Yeah.
two of the units into a short term, because I just don't have to rent it out that many nights to make what I was making on the long term. So I'm like, it feels fairly safe. I was almost going to say risk free, but I'm like, that gives the wrong message. So um, fairly a safe investment.
Yeah. I think the one thing that I experienced with my short term and kind of why I decided to go the long term was the utility payments. And,
They'll get
depending
you.
on your market, you know, for us here in the Northeast, we have really cold winters where the heat's on for almost half the year. And my properties were gas. And so,
Mm.
um, gas was really expensive this year. Not necessarily the gas, but the delivery fee of the gas from the gas company.
Oh,
And
is it like
so,
a tank that you've got, an exterior tank?
no, so that's usually oil. You usually have an oil tank.
Okay.
Gas is still like they still charge you a delivery fee depending on how far away from the main line you are. And
Oh,
so
okay.
it takes longer to get to your property based on, where the main supply is coming in. And so where my properties are located, I was paying these hefty delivery charges. And so in the months, of course, that I'm not typically rented here in a college town are the winter months. That's where I had the highest utility bills, and I didn't have the cash flow to offset it. And so that was one of my biggest kind of thought processes with, yes, and this is crazy, I had made $10,000 in one weekend before. Yeah.
Oh my gosh.
Yeah, one weekend.
Amazing.
Yeah. But obviously that wasn't going to be sustainable. It's not going to happen. But, football season, we kill it. 7 weekends out of the year, you're making at least $3,500 a weekend. And, if you can make that stretch across, you know, all 12 months, great.
Right.
But again, to your point on the rental restrictions, in my market, you have to be an owner occupied in order to rent out your unit, or you have to have a long term tenant in place who can then sublet out their unit on a
Okay.
short term basis. And so
Okay.
I kept getting the flag, your property is noted as not
Uh,
being, your primary residence. And so um, I'm on our planning commission, and I decided that it would probably be better to just play nice and uh, follow the laws,
the letter of the law. Yeah.
follow the rules. But I like your idea of testing the market. And I think testing one unit and seeing, does that work? Are people still interested in kind of the smaller living style over a single family? And, what's the draw, and understanding who are you marketing to?
Yes.
So, what kind of softwares, or what kind of places do you typically post for your properties to find tenants?
So it's about to happen. I haven't made the conversion yet, but in the past, what I've done is Airbnb and VRBO for the short term. Furnish
Mm-hmm.
Finder, I'll do for the midterm stuff. And
Mm-hmm.
the midterm stuff, I'll still post on Airbnb and VRBO, but I'll just say 30-day minimums. And like within 5 minutes of posting our very first Airbnb that we were running, we did it for 30-day minimum because we had a condo and an HOA had a
Yep.
restriction. It got booked for 30 days. And we're like, holy crap, like
Wow.
people are actually doing this.
Did
And
you
so,
think like maybe I should have charged more?
yeah, 100%. I was like, wait, we screwed up. But the other thing is both my wife and I looked at each other because it was our primary. We were like, well, where are we going to go live for a month? And so we bounced around. It was during the pandemic. And so we went and stayed with in-laws. And then I had
Mhm.
hotel points. So we stayed at a hotel near some friends. So it ended up working out great. But it was just so funny. We were like, oh, it actually happened. Now what?
Yeah, that's awesome.
Um, so yeah, those three platforms have been really great. Really, really
Yeah.
great.
I'll throw out another one. I use Hospitable, and
Oh, okay.
so it basically manages the communication between all of your tenants, whether they book on Verbo, Airbnb, Booking.com, anything like that. And you set up automation. Send them an email a week before they check in. Send them a text, the night before, and it gives them all of the information that they would need as far as all of your key things for the property, the check-in instructions, everything. And you can set it so that they're getting these messages continually throughout their stay, and it kind of looks like you're creating this personalization to them and building in some rapport to help with your ratings and reviews.
I love that. Thank you so much. I just wrote
Yeah.
it down because yeah, this is the stuff that we were doing it all manually before, and we're like, it's kind of a pain in the butt. So now that we're
Yeah.
looking at doing it, especially remotely, that's gonna be awesome. That's great.
Yeah, it's like $40 a month. So worth it.
So worth it. So worth it.
Yeah.
It's like 3 Chipotles. That's great.
Exactly. Exactly. Well, maybe where you are. Ours are a little bit cheaper, but
Oh, that's great.
um, okay, so before we kind of move on, I want to talk about your latest prop tech company and kind of what you're building, what you're working on, and how you're helping investors kind of simplify this process. Because I think just generally from our conversation, it takes a lot of data and a lot of research to understand a market, to understand things that are happening in that market, sale prices, rent prices, eviction laws, all of these things that are going to impact an investor. So tell me more about the company you created and like the product that you're delivering.
Thanks so much for asking, Mallory. I appreciate it. So, I created a real estate education platform and company called MyFi Academy. And then I just became a co founder in this other company called Bold Street AI. And the whole idea behind it is to help investors identify cash flowing properties throughout the country. And so we're basically grabbing a ton of MLS data, allowing people to search using the filters that they're likely familiar with using on Zillow, like bed, bath count, square footage, year built. But then we've also layered in a financial filter. So you could say, I'm looking for a 3-2 single story in Cincinnati, Ohio that cash flows $150 a month at a 7% cap rate. And it'll go find every property out there and highlight, hey, these meet your criteria based on a number of other different filters you can plug in as well. And so we're just trying to remove a lot of the monotony and repetition of, okay, here's a property, it's listed for 250, I think it'll rent for whatever 2,500, let me put it in my calculator, oh, it doesn't work, crap, okay, back to the drawing board. So we've done all of that for folks, and so you get to basically build your own buy box, as we call it, your own
Mhm.
framework around what makes an ideal investment property for you.
Yeah,
And we kind of harbor on the for you piece because you and I are both investors, but if we have different strategies, what makes an ideal investment property for you and me could be vastly different. And so,
exactly.
and we want to also help remove emotion from the decision making process. So we've built out some really cool spreadsheets. Really cool. Listen to me. I'm obviously biased because I built it, but I think they're functional, and it's like made for investors by investors. And so
Mhm.
these were all of the things I wish I would have had access to when I first started investing. I was like, let's just put it into this technology. And so it tells you like, yes, this property meets your criteria, or no, it doesn't, for all these different line items, like discount to market, rent potential, square foot, crime score, school score, all these various factors. And so you can see, okay, how many green checks am I getting versus how many no red checks am I getting? And am I willing to move the needle? Am I willing to fudge on my numbers? Yes, no, maybe so. Only you as the investor get to make that decision, but you kind of faced with, hey, these are the facts, these are the numbers. Is it a go or a no go? And then
Yeah.
we've also paired that with a nationwide network of real estate professional vendors. So think lenders, property managers, agents. And what we've realized is that doing it yourself, like building a new team,
Mm,
I'm a perfect example. Building your team in any new market you want to go operate in is just a
yeah.
grind. Like
It's
it
hard.
is just a lot of work. There's no
Yeah.
two ways about it. And so we said, hey, let's set up a team for people in advance that they can just plug into. We've already done that due diligence, that legwork. You know these people are good, and you don't have to work with them, but this is at least a name and a number to get you started in a particular market to plug into. If you use them, great. If not, that's cool too. But to be able to allow investors to really invest in the market that makes the most sense for them, and not let the grind, the team building be a hurdle they have to overcome. So we've paired kind of all three of these things together: the search technology with with the tech platform, the network with the education, to really help empower investors to, again, be able to invest in the markets that they're interested in, and not let either education, geography, or searchability be a restriction for them.
No, that's amazing. And it's almost like you created a enhanced Zillow with an Angie's List and a YouTube channel all put together as a package deal.
Yeah, okay. I am so glad you said that. So as we were building this, I would turn to my other co-founders. We have two partners, and I was like, guys, we're kind of building the Zillow for real estate investors. They're like, I know, it's crazy, right?
Yeah.
So we're super excited about it. So I'm glad that you think so too. But
Yeah.
yeah, we're
No,
we're thrilled.
I,
We're
I
thrilled.
can't wait to use it. Like, I'm excited to use it. So I think it's really cool. Now, is this all markets across the US that you have these connections, or just like larger markets?
So right now, I think it's 35 markets that we've got connections in.
Okay.
But we're nimble enough in that we've seen what works. We know what the process is. So if there's somebody out there that's like, hey, I want to invest in this market and it's not currently supported by us, or on our roadmap, we'll look at the size of the market and determine, hey, is this worth it? I mean, is this going to be a one-off where we might not be able to be as helpful, versus, hey,
Yeah.
we've gotten 5 other requests for this, we're going to go build that team for you and come back to you in a week and say, hey, here's who you should go talk to. Which is super exciting. The other thing that I think is really exciting is that so many of our lenders are nationwide. So we'll go build the team boots on the ground from a property management agent perspective, but we can definitely serve every market in the country from a lending perspective today. That's for sure.
Yeah. Well, and eventually I feel like you guys will become the lenders as well and just add another leg onto your your company.
I could see it. I could see it. I could totally see it.
Yeah, it makes total sense. Okay, so Michael, one of the last things that I always like to ask my guests are books that you recommend for either new investors, investors that are looking to get into multifamily, or just general mindset, anything like life skills for people looking to expand their horizons.
Yeah, so I'm biased because I'm a remote investor. I'm a long distance remote investor, and so there was a book written by, I think it was Brandon Turner over at Bigger Pockets. I think it's called The Book on Long Distance Remote Real Estate Investing. I probably butchered that title, but it's something to that effect. If you Google
Yeah,
that, you'll get the result. That I think was super impactful for me, and it also just kind of reaffirmed so much of what I had figured out kind of by failing forward on my own.
yeah,
because I wasn't aware of bigger pockets. I wasn't aware of that people were doing this. I thought, again, so naively, that I was like this trailblazer. I'm like, oh my God, I figured this thing out. And I'm like, oh wait, no, a bunch of people have already been doing this for a long time and doing it way better than me. So it was very affirming to see that there is community out there, and there is like a recipe for this. You don't have to go fumble through it yourself. And
Yeah.
that's so much of what I incorporated into our education platform is like, look, here's all the stuff you actually need to know. There's a bunch of stuff out there on the internet and in the world of education. Some of it's great, some of it's not so great. Here's the things that I wish I knew. Here's the steps that I took to actually do the things that I'm talking about, that I've done, that I'm now qualified to speak on. Because
Mhm.
there are a lot of folks out there pushing programs or courses or gurus, and it's like, you're not doing this stuff. You're selling something.
Mhm.
I'm helping. I like to think I'm helping people do the thing they're trying to do, which is invest. And so
Yeah.
that's really where my mindset was when I built this. Hence the book recommendation.
Love it. Okay. Thank you. Michael, any last piece of advice for our listeners here that are thinking about taking the dive into real estate investing?
Yeah, it's just not that hard. It feels scary, and it feels really hard, and it maybe even feels impossible. But if you understand what it is that you're trying to do, and you take a step back for a minute and recognize that not doing it is going to be scarier in the long run. And so I think if you can just push yourself and know that the sky's not going to fall, you're going to be surrounded by people that have been doing this for a very long time. You're not alone, and if if you do your homework, you're not going to be totally caught off guard. You're going to be okay.
Yeah, love that. Michael, it has been an absolute pleasure having you on this show. I
No, the
don't think
pleasure was
I've
mine.
I don't think I've had this much fun in a while. So I appreciate, the banter back and forth and just kind of
Yes.
a lot of the same mindset and similarities. So again, thank you so much for being on the show. And if people are interested in learning more about your software or your course, where can they go?
Yeah, go to boldstreet.ai.
Okay. Awesome. We'll make sure that's included in the show notes below. And that wraps us up for another episode of Inspire Wealth. I am Prof M out. And for those who want a more hands-on learning experience, check out our online courses at inspirewealtheducation.com. Whether you're just starting out or looking to expand your investment portfolio, I've created step-by-step guides and resources to help you achieve your financial goals. So hit that subscribe button and let's start building your wealth one episode at a time.